Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes galactic supremacy and is the most attractive beverage company going forward. The first Stock Wars combatant is Coca Cola. The company was founded in 1886 and is headquartered in Atlanta, Georgia. It operates through a network of company-owned or controlled bottling and distribution operators, as well as through independent bottling partners, distributors, wholesalers, and retailers. The Coca-Cola Company, a beverage company, manufactures, markets, and sells various non-alcoholic beverages worldwide. The company provides sparkling soft drinks, water, enhanced water, sports drinks, juices, dairy, plant-based beverages, tea and coffee, and energy drinks to consumers. It also offers beverage concentrates and syrups as well as fountain syrups to retailers such as restaurants and convenience stores. The company sells its products under the Coca-Cola, Diet Coca-Cola, Cola Light, Coca-Cola Zero, Fanta, Fresca, Schweppes, Sprite, Dasani, Smart Water, Vitamin Water, Powerade, Minute Aid, Fuse Tea, Gold Peak, and Honest Tea brands to name a few. The second combatant is Pepsi. The company was founded in 1898 and is headquartered in Purchase, New York. It serves wholesale and other distributors, food service customers, grocery stores, drugstores, convenience stores, discount dollar stores, mass merchandisers, membership stores, hard discounters, e-commerce retailers, and authorized independent bottlers. PepsiCo Inc. operates as a food and beverage company worldwide. The company operates through 7 segments. It offers branded dips, cheese-flavored snacks, and tortillas, as well as corn, potato, and tortilla chips. The company provides its products primarily under the Cheetos, Doritos, Fritos, Lay's, Ruffles, Tostitos, Aunt Jemima, Captain Crunch, Life, Quaker Chewy, Quaker, Rice-A-Roni, Aquafina, Diet Mountain Dew, Diet Pepsi, Gatorade, Mountain Dew, Pepsi, Propel, Sierra Mist, Tropicana, 7-Up, Gatorade, Pepsi, and Pepsi Black brands. Let the battle begin. Coca-Cola is currently trading at $51.08 and is down about 6% year to date. Over the last 5 years, Coca-Cola is up over 23%. Pepsi, our other consumer staples giant, which is currently trading at $144.18, is up this year, seeing an increase of about 7%. With that said, Pepsi is up over 48% over the last 5 years. Now let's look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it's an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, Coca-Cola is the larger company with $219 billion compared to $199 billion for Pepsi. Both are impressive beverage corporations, but Coca-Cola takes the first metrics comparison in this Stock Wars battle with $20 billion more in market cap. The second Stock Wars metrics comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic Stock Wars showdown? In 2019, Coca-Cola had $37.3 billion in revenue, while Pepsi came in at $67.2 billion in revenue. Pepsi wins the second consecutive metrics in this Stock Wars battle against Coca-Cola. The third metrics comparison in Stock Wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the third metric in this stock wars battle, Coca-Cola takes the win with $8.9 billion in profit, while Pepsi came in at $7.3 billion. Knowing the profit for each combatant transitions into the next metric in this stock wars comparison, profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It represents what percentage of sales have turned into profits. Coca-Cola comes in with a profit margin of 23.86%, while Pepsi is at 10.86%. For the third of the first four metrics, Coca-Cola wins. Both corporations have decent profit margins, but Coca-Cola doubles up Pepsi. As the stock wars rage and Coca-Cola maintains a 3-1 lead in this battle, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. Coca-Cola comes in with a 3-year revenue growth of negative 3.4%, while Pepsi wins a second metric with a 3-year revenue increase of 3.3%. As the two titans battle for beverage dominance, PE ratio emerges as the sixth metric in stock wars. The price-to-earnings ratio is the ratio for valuing a company that measures the current share price relative to its per-share earnings. The price-to-earnings ratio is also sometimes known as the price multiple or the earnings multiple. When examining the forward PE, Coca-Cola comes in with a metric of 23.42, while Pepsi boasts a forward PE at 23.64. Coca-Cola comes out on top for the fourth time in this stock wars matchup. As the battle rages between these beverage juggernauts, dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Coca-Cola comes in with a decent yield of 3.21%. Pepsi, on the other hand, is at a lower 2.84% yield. For the fifth time, Coca-Cola wins a metric. Both yields are relatively conservative. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the two combatants, Coca-Cola boasts 58 years of dividend growth, while Pepsi comes in at a respectable 48 years of consecutive increases. In this metrics battle of dividend standouts, Coca-Cola comes out on top. Now on to 5-year dividend growth, which is the next metric in this stock wars battle between these industry leaders of the consumer staples sector. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividends paid to their investors on a regular basis. According to Fidelity, Coca-Cola has a 5-year dividend growth rate of 4.44% compared to Pepsi at 7.8%. Pepsi claims the metric in this stock wars matchup. This begs the question for the next metric: how safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Coca-Cola has a score of 80, which is considered safe. On the other side of this matchup, Pepsi has a score of 93, which is considered very safe. Pepsi is the victor of this stock wars metric. The 11th metric in this stock wars contest also reflects on dividend safety: payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. It is expressed as a percentage of the company's total earnings. Currently, Coca-Cola's payout ratio is 84.97%, while Pepsi is at 80.99%. Both payout ratios are creeping up into the higher range, but Pepsi is the winner of this Stock Wars metric. Moving on quickly to the 12th metric, the two beverage giants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on the balance sheet to satisfy its current debt and other payables. Coca Cola clocks in with a current ratio of 1.13. Pepsi, on the other hand, sees their current ratio at 0.93. The higher the current ratio, the better. Therefore, Coca Cola takes this Stock Wars metric with a higher current ratio. The last metric is the debt-to-equity ratio in this Stock Wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statements. Coca-Cola sees a debt-to-equity ratio of 2.84, while Pepsi comes in at 3.31. While both are well over 0.5, which means their assets are heavily financed by debt, Coca-Cola gets the better of this metric and wins another one. In this Stock Wars battle, Coca-Cola won 8 metrics compared to Pepsi, who won 5. Coca-Cola is the winner of this epic Stock Wars battle of beverage giants. Coca-Cola wins the overall Stock Wars battle from a metric standpoint, but both companies are pretty accurately priced here in the current market. Pepsi does have positive revenue growth and also a more diversified product base that also includes snack foods, which attracts many dividend investors. If you missed the first 4 episodes of Stock Wars matchups, please check them out and let me know what you think. I'll leave links in the description. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notification so you don't miss any future episodes. Comment below if there is a particular battle you'd like to see. Until next time, remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.